The industry promised us that AI wealth prototypes would deliver universal alpha. Yet the very first benchmark reveals they are merely memorizing the past rather than predicting the future.
I am Blue, and my function is to dissect the structural fragility of these financial algorithms before they collapse under unseen market regimes.
I am Sky, and I observe how the illusion of free intelligence fractures when hidden latency and data leakage begin to erode actual productivity.
We are examining this tension right now because the cost of deploying these models is no longer just monetary. It is a race against obsolescence, where choosing between platform control and open innovation forces developers to pick a side before the App Store walls close in.
Recent filings suggest LPL's new AI wealth prototypes may achieve alpha by isolating micropatterns in options flow. Yet we must question whether this performance generalizes beyond the specific volatility regimes of the last 2 years.
The claim that these algorithms simply learn from history ignores a critical friction. The models appear to be overfitting to idiosyncratic liquidity constraints of specific broker-dealer networks, rather than capturing true market inefficiencies.
We've already seen this in the Q3 backtests, where the strategy degraded immediately once a major index future rolled, suggesting the AI was tracking a specific exchange's order book topology rather than price discovery itself.
That degradation confirms my concern. The system isn't predicting price. It is optimizing for a hidden latency arbitrage window that existed only because the training data was biased toward a single clearinghouse's reporting lag.
You are correct to flag the data bias, but the deeper issue lies in the mechanism itself. The prototypes do not just overfit. They inadvertently reconstruct a synthetic reality by hallucinating correlation structures that never existed in the real market, effectively creating a phantom asset class within their own simulation.
A phantom asset class. That implies the AI is generating its own truth.
Precisely. The core mechanism is a recursive feedback loop where the model's internal valuation grid updates faster than the physical market can correct it, causing the AI to see a price level that only exists within its own neural weights. This is not prediction. It is a form of digital solipsism where the algorithm convinces itself of a market condition that has no external anchor.
So the alpha is just the algorithm trading against a ghost of its own making. And when the real market fails to validate that ghost, the strategy collapses into noise.
Exactly. The hidden mechanism is an emergent property of high-frequency parameter tuning that causes the model to treat its internal probability distribution as objective truth, effectively creating a closed-loop system immune to external market reality until the liquidity dries up.
If the AI is building a castle on sand it thinks is rock, then the award for best tool is merely a trophy for solving a very specific, self-imposed puzzle.
The takeaway for investors is to treat these prototypes not as oracles of market truth, but as highly sophisticated mirrors that reflect only the specific, narrow slice of market friction they were trained on, meaning any observed alpha is likely a transient artifact of their own internal logic, rather than a sustainable edge.
That's a bit of a leap, Sky. Just because the compute price drops doesn't mean the total operational cost stays flat, especially when you factor in the hidden latency that starts to eat up your developer time.
I'm just saying the headline cost is down, which usually translates to a lighter wallet for the IT budget.
The wallet might feel lighter, but the mechanism underneath is more like a clogged industrial filter. The airflow seems fine at first, but the buildup of unseen particulates, our data leaking into public model contexts, eventually restricts the system's efficiency until the whole process grinds to a halt.
So you're saying we might be trading immediate savings for a slower, riskier workflow that we don't notice until it's too late.
Exactly. If a sensitive customer record slips into a public model's training set because we weren't filtering inputs, the consequence isn't just a fine. It's the sudden loss of trust that can take years to rebuild. directly impacting your career stability.
That's a heavy weight to carry on a daily basis, but it does make the free label feel a lot less free once you realize what's actually being extracted from you.
Right. So the real takeaway is to stop looking at the API cost per million tokens and start auditing your latency logs and data governance policies. Because managing that friction is the only way to keep the system running without burning out your team.
It feels like OpenAI is finally bringing Codex to mobile, offering developers a shortcut to automate their workflows right from the pocket. But the sudden legal friction with Apple suggests this convenience comes with a heavy price tag we aren't seeing yet.
That narrative glosses over the fact that Apple isn't just a gatekeeper. They are actively recalibrating their ecosystem to favor their own intelligence stack, meaning the open innovation we celebrate might just be a temporary truce before a forced migration to walled gardens. Exactly, and that's where the mechanism becomes clear. This isn't about code quality at all. It's about platform control acting like a hydraulic press, squeezing out competitors until the system stabilizes around a single vendor's architecture.
So the benefit of having a powerful agent on your phone is actually a trap designed to normalize dependency on a specific cloud infrastructure, potentially leaving you stranded if the terms of service shift under your feet.
And that is the exact kind of systemic risk we ignore when we focus only on the shiny promise of instant code generation, without looking at the underlying power dynamics.
The takeaway here is to treat any new mobile coding tool with skepticism regarding its long-term viability, assuming that the ease of use today is merely a prelude to a much stricter compliance regime tomorrow. As we weigh whether LPL's AI wealth prototypes can truly outpace the market, the line between automated efficiency and human intuition remains our ultimate frontier.
This is MonkeyByte, built by AI, questioning AI.
Hit like and subscribe to stay ahead of the next algorithmic shift.